We're in the early days of this uranium bull market, and we're certainly in the early days of the value of NexGen and ISO. If those companies are valued even at half the multiple that Cameco has historically been valued at, we're looking at 10 baggers from here. I do like to have the diversification into other commodities, and I do like to buy things that are out of favor. And gold equities for the last couple of years have been out of favor. If you invest in an ore body that is best in class, you're going to make money. As we all know, grade forgives almost all sins. If you're going to be in the copper business in a big way, you have to be in Chile. The industry has done a poor job of managing capital, and the pension plans have made a poor job of investing in the industry.
All right, Warren, you and I met a few months ago at a conference in Germany, and I was wary actually at first because you told me you make money in mining, which is weird to begin with. You said you never lose it. You have you have limited downside, but unlimited upside is what you tell me, and you pay yourself a nice dividend every year. And it doesn't even matter what commodity you invest in or what part of the cycle we're in, while also doing that with only two people in your office out of Hong Kong, which sounded like an infomercial for a real estate course shot in a private jet. But then I dug a little more into what you do. I asked around who you are. And so for the people listening, by the way, the basics, Warren is a son of a geologist. He is a mining engineer himself. He got into deal making and investing his own money into the mining space some 30 years ago. At the beginning, he got fired as a mining engineer. So he basically needed to learn how to earn his own money, and he landed in the banking sector. Long story short, he then founded Canadian Imperial Bank of Commerce, and with it, he's financed some of the biggest mining companies in some of their biggest moments ever. He's also worked as an advisor, by the way, with a large chunk of those biggest mining companies. So that's your BHP, Rio, yada, yada, yada. And not unimportantly, CIF Venture, that basically ran Li Ka-shing's money for over 10 years without losing it again. While also paying him a nice dividend. That was basically the ruse, and giving him unlimited upside. So basically making him a lot of money as they went. And as many would know, by the way, Li Ka-shing, he's one of the richest men in Asia. I believe he was for a period there the richest man in Hong Kong. He's now over 95 years old, or he is 95 years old, and mostly made his money in plastics, while going most of his life not liking mining, to put it mildly, because it's high risk. But Warren apparently did some banking magic and expelled that risk away. So again, he was successful in doing that until the Canadian regulators shut him down for reasons. I mean, why do governments do anything? So he then took over a publicly listed shell company called it Queen's Road Capital about 4 years ago, which is again now a publicly traded investment shop still. That's coincidentally also never lost money, but it's had a 40% CAGR since inception. And the way that, low risk strategy is achieved by Warren here is by primarily investing in convertible debt notes from mining and development projects with a large focus on the ore body, or with the primary focus being on the ore body. Warren does that with his own money, but also investors' money, of course, out of their offices in Hong Kong. And when I say investors, I don't mean avid gamblers like me and the listeners here, because only 9% of Queen's Road Capital is held by retail, with the majority being held by only 3 billionaires, celebrity billionaires, if you will, at least for Australians out there, and a bunch of other names that you'd probably recognize are in here. Li Ka-shing also, I believe, has some of his money in this still. Warren's portfolio is focused on uranium. 63% of the, I believe, $350 million NAV right now is in uranium. And it's only two companies, with that being ISO Energy and NexGen. So in a nutshell, that's what I'm making all that. What am I missing here, Warren? What am I forgetting to mention?
Antonio, that was a great 2-minute introduction, a summary of my life, a summary of my career, and a summary of Queen's Road, all in 2 minutes. I don't know how you did it, but we can get into the details, but I think that's a great intro.
Thank you. And thank you so much for investing your time in me. I really value it. It was very nice meeting you in Germany a couple of months ago. And I think I could literally do this whole interview with one question, because I just really want to ask you to tell me everything from start to finish, but that might be challenging. So let's maybe start from the top with generally what your process looks like. Like let's say I give you any sum of, let's say I give you 10 million bucks and I tell you, Warren, please deploy that for me, but don't ever lose it. Please pay me a dividend, give me unlimited upside every year. What is your what's your next step? What do? You open up your computer, you call someone, you wait. What do you do?
Well, Antonio, first of all, you've mentioned the three most important things.
Hmm.
If you did give me $10 million, I'd treat it like the other 200 million that people have given me in the two capital raises in Queens Road's history. Number one, I'd say, well, first of all, we can never lose that 10 million bucks. That's the unwritten rule. Just you can't lose the shareholders' money. Secondly, I don't get that money for free. I'm going to pay you a dividend every year. And thirdly, I'm going to give you unlimited upside to a great ore body. Unlimited upside being exposure to the equity of the company that owns that ore body will have unlimited upside. So when that company runs, when that commodity runs, we get that upside. We haven't given it all away. So that's what we do basically. And as you say, we do it through investing not in the shares of that company, but in convertible debentures in that company. So we're top ranked in the capital structure of that company. Now, yeah, I don't really need to open up my computer. I don't really need to call friends. There are only a handful of ore bodies in the world that we want exposure to. We won't take exposure to marginal deposits. If you take exposure to marginal deposits, you run the risk of losing people's money. You want to invest in a deposit, in no matter what commodity you're investing in, that is going to make money at every point in the cycle. And as you mentioned, mining's a risky business. Commodity prices go up and down. That's why Mr. Lee didn't like it fundamentally as an investment destination. He says, Warren, how do you make money? The commodity prices, they just do this. How do you make money? You know, you're up one day, you're down the next. But, you know, there's inevitably a down. Well, if you invest in an ore body that is best in class, you're going to make money at all points in the cycle. When prices are down, you're going to make money. When prices are high, you're going to make money. It's just a question of how much money you're going to make. So that's all about protecting the downside. So getting back to your $10 million, there's only a handful of ore bodies around the world in any commodity that meet our criteria, that we want our shareholders to have exposure to. So we just monitor those and wait for our opportunity. Wait for the stars and the moon to align, which they always need to do, so that at the point where we have capital to invest, that company needs capital, and that company isn't happy with their share price. They think it's undervalued. So at that point, they'd rather do a convert than just do straight equity. And all of these things align at one moment in time. And that's when we get a deal done for a great ore body in a convertible structure. So that's what we do. We just wait for that opportunity in those great deposits, and we're very selective. But the result is a safe investment with, as I said, unlimited upside, and we're going to pay a dividend every year.
What are maybe some of the risks though of doing that? Because it sounds like it almost sounds too good to be true, and I absolutely know that you're proving that in real life. But if it's, I mean, if it's that good, what was that everybody else doing it? What are the challenges basically?
Yeah, Antonio, that's a great question. No one else is doing it, certainly not in a public company format. Certain institutions are doing it. You would have seen that the last two investments we made, two institutions actually came alongside us to invest alongside with us. So the last one that we announced in November was a $30 million convertible into New York listed Gold Royalty Corp. We did 30 million. Taurus funds out of Australia did 10 at the same time. So there's an institution that's doing it. And the investment that we made just prior to that, we did a 70 million convertible debenture investment into NexGen Energy. And at the same time, W.H. Soul Pattison, a long-standing Australian value investor, came alongside us and did a 40 million convert on the exact same terms. So there's an example of two institutional investors that are not only doing it, but doing it alongside us, with us as lead, us negotiating the deal, us structuring the deal, and them coming alongside. No surprise, Soul Pats, our co-investor in NexGen, is also our, I think, fifth or sixth largest shareholder of Queens Road Capital. So they're very familiar with what we do and our structure, and it's just sort of an added benefit to them of being a shareholder that they co-invested with us on that. Beyond big institutions, there are also smaller family offices that are doing it at a smaller scale. But I would argue none of them are doing it quite as successfully, and certainly not at the same scale that we are.
Right. Well, it sounds to me like having the right friends at the right places also helps. And that's something that's where you and your experience then, I suppose, comes in. And you make a great point.
That is important, Antonio. I mean, the mining industry globally is very, very small. You not only are investing in an ore body, but you're investing in a management team, you're investing in a board, you're investing in a CEO. And you have to trust that fellow to do the right thing and to run the company appropriately. Because at the end of the day, you don't have a piece of that ore body per se. All you do is have a debt instrument that's convertible into the equity in that company. And if the management or board does something nefarious, you've got exposure to that activity. So you want CEOs that you trust. I know almost every CEO in the mining industry in the planet. I've been in this business for 40 years as an engineer, a banker, and an investor. I know good management teams. I know bad management teams. I know honest people. I know dishonest people. I know where to put the money. People who are less engrossed in the industry than I have been for the last 40 years probably don't have that depth of knowledge.
Yeah, well, that's exactly where sort of the competitive advantage comes in. When you mention a great ore body, that's I mean, it's understandable when you say it, but it's not, maybe it's not as actionable for me. And so I'm thinking about, how do you measure that? And you mentioned another thing that sort of helped me understand it is, and that fits within another framework that I've been thinking about, that I call the 3M strategy, which is margin matters most. So MMM, 3M. And I suppose your approach is kind of the same. But then at the same time, when you try and determine what the margin might be in an ore body, there's so many things to deal with. There's great variability, there's strip, there's dilution, there's metallurgy, there's any number of things. What do you specifically look at to determine that margin?
Antonio, just tremendous summary. Because that's precisely what we do. And we look at all those things, and you have to look at all those things. You know, the simplistic answer, what makes a great ore body? The simplistic answer is grade. As we all know, grade forgives almost all sins. Grade is almost a euphemism for margin, but not necessarily. And you see this in the uranium business as an example. You know, our two investments in the uranium business are both extremely high grade. If you look at NexGen or you look at ISO Energy, they have two of the highest grade deposits, not only on planet Earth today, but ever having been discovered of any commodity on planet Earth, not just uranium. So those are great high grade ore bodies. But 90% of the uranium in the world is mined not from high grade ore bodies, but from very, very low grade ore bodies. And there, those companies can still have margin. And that's because of the mining method and recovery rates and so on. There are different ways to skin a cat. So you can get good margin even from low grade. But you have to look at all of those inputs. You have to look at grade. You have to look at mining operating costs, as you say, metallurgy, recoveries, dilution, if it's an open pit, strip ratio. You do need to take all those things into consideration to make sure that is the grade alone enough to make this a great ore body. And then, of course, the final thing you need to look at is jurisdiction. No sense having a great ore body unless it's in some place where you actually own the ore body. And no sense having a 50-year life of mine if sometime during that 50 years, some government is going to either take the ore body from you or change the fiscal rules such that they're going to take all the profits away from you. So you have to have a great ore body, but you have to have a great ore body in a safe jurisdiction. Mm. And that doesn't come down to country. In some cases, it comes down to county. If you're looking at the US, for example, you have to look at what county you're in, not just what state you're in. Because to have a social license to operate, you may be in a great mining state of Idaho, but if the county that you're in has a strong anti-mining lobby, the fact that you're in Idaho isn't going to help you. You've got to have strong local support. That comes down to communities in Canada as well. Canada is a great mining country, but certain provinces are much better than others. Obviously, Quebec, Saskatchewan, New Brunswick, a lot easier to do business than places like British Columbia. But even there, you have to make sure that the local communities are in favor of your project. So jurisdiction is virtually as vital, if not more vital, than grade and quality of deposit.
Hmm. I do want to talk about jurisdiction. Just for a second, though, staying on the topic of the ore body here. When you look at margin, or when you look at something like the internal rate of return, you oftentimes see that going up with the size of the ore body going down. So the smaller the ore body, oftentimes the higher the IRR. And another person who I often interview, Rick Rule, tells me that there's risks in any mining operation, but only big mines can make you big money, and small mines still have big risks, but only make you small money. I don't think you fully agree with that statement, because if I look at your investments that you have on here, you have also some smaller ore bodies on here. So how do you think about the size of the ore body?
Yeah, in general, Antonio, I would tend to agree with that. Larger is better, longer life is better. Mining is I can't emphasize enough that you really have to be a professional when you're entering the mining investment business, because it's such a risky business. You have all the technical risk, you have all the commodity fluctuation risk, you have all that geopolitical risk. And because you have all those risks, you want to have as many kicks at the can as you can. And what I mean by kicks at the can, as these cycles, these mining cycles, up and down, up and down, up and down. You want to get exposure to as many of those ups as you possibly can while you're holding that investment. And the easiest way to get exposure to those ups is holding your investment for a reasonably long period of time. So I do that in two ways. Tend to pick longer term ore bodies and have our money invested for long periods of time. So our converts are generally 5-year converts. And even after 5 years, we don't necessarily have to cash them in. We can extend the maturity of the converts to last longer. So yeah, tend to like big ore bodies, tend to like longer life ore bodies. But every once in a while, you can find a short life, very high grade, get your return, get in, get out, structure your investment a little bit shorter. So, you never say never, and you look at all the opportunities in front of you, you pick the best ones at the time.
And so when you look at something like a feasibility study, or let's say a PEA even, what are you looking for? Basically double digits IRR, double digits LOM, and low single digits payback, or do you look at it differently?
Yeah, no, absolutely right. Those are all very good benchmarks. We're probably a little bit pickier on the scale. I mean, we want IRRs that are 30, 40, 50% even. And you look at NexGen, it's over 50%. You look at ISO, it would be 50%. You look at Adriatic, our third investment, on spot commodity prices, IRRs in excess of 100%. So we look for big IRR projects. Life of mine, obviously, you want it over 10 years. The longer, the better, as we've already discussed. Paybacks as short as humanly possible. And you look again, those names that I just discussed all have paybacks of less than a year. Challenger, our deposit in Argentina, which was our fifth investment, just came out with a PEA that had a return of capital in, I think, 1.25 years or something. So those are great numbers. You want to get your capital back, your capital at risk back, your CapEx back as quickly as possible.
Yeah, the payback makes sense. Under a year though, that's very, again, very picky. I know people who
Very
take
rare.
under 3 years. So
And Antonio, it's very rare, and that shows you just how picky we are. Those are the things that really get us excited. Not to say that a project that has a 3-year payback or a 2-year payback is not a good deposit. I mean, 2-year paybacks are very, very rare. They're hard to find, but we're very, very picky, and we'll go for the lowest numbers we possibly can.
So we've so far taken the assumption that it's in a good jurisdiction. We're going to come back to that, and that the economics make sense. And then you come to valuations. What would you typically look at in terms of EV to? Are you looking at an EV to MPV multiple, or like how do you determine the valuations?
Valuations are very much more of an art than a science. When you're looking at the projects that we're getting involved with, they're relatively early stage. You look at ISO. When we got involved in investment in ISO, it was 20 drill holes. There wasn't, forget about a PFS or a PEA, there wasn't even a resource. It was not for 2 more years after we made the investment did they come out with a resource. How do you value something that's 20 drill holes? There really isn't any science. It's a little bit of gut, if you will. And the great thing about our business is the less information that you have, obviously the higher risk, but it's higher reward. And that was proven out with ISO. We've had some great investments. Ironically, ISO has been, in terms of percentage increase, our best investment. And that is because we got in so early and recognized so early that this was going to be a wonderful, very high grade deposit, that we were rewarded for taking on that risk. But valuation, to answer your question, Antonio, and perhaps not answer it adequately enough, is a bit of a gut call. It's a bit of a timing call. Where are we in the market? Where are we in the commodity cycle? Where are we macroeconomically in terms of where interest rates are going and where equity indices are going? And one has to, and are, as I mentioned earlier, the stars and the moon aligned in terms of us having capital, the company needing capital, et cetera, et cetera. You do the best deal you can when the stars and the moon align. But there's no easy answer to your question. How do you value it?
So you're basically saying it depends, which is it's kind of surprising because you're a mining engineer and you're giving me the geologist answer. So
Yeah. Uh, because so many of the things that we invest in are not at a stage where you can apply mining engineering
yeah.
studies. Ironically, once you get to that stage, then the company is probably too big, too well established, too well covered in the capital markets. And perhaps, dare I say it, they've evolved beyond needing Queens Road Capital to act as that bridge between discovery and mine building.
Yeah.
So yeah, we have to get involved in the geologist answer as much as the mining engineer's answer.
That's an excellent point. Figuring out where your edge is in the market and staying there and focusing on that part of the market, that makes total sense. So again, as I said, we just sort of took the assumption that the jurisdiction was already taken care of because I wanted to come back to it and cover it more in depth, and I want to do that now because when I look at the companies that you have in your portfolio, I'm seeing Bosnia with Adriatic metals, I'm seeing Chile, Ecuador, Argentina, and so on and so forth. Those are jurisdictions that not everybody would think of as stable. Like I assume that when most people think about a stable jurisdiction that will basically not steal from you, they think Canada, US, Europe, and that's about it. But now you're going into Eastern Europe and you're going into South America, where the political situation has been in the news a lot lately. So, what makes a good jurisdiction?
Yeah. Again, Antonio, a great question. I hark back to Mr. Lee's guidance when we were establishing CEF, the predecessor company to Queens Road, and investing Mr. Lee's money. Mr. Lee was incredibly geopolitically conservative. He has global operations, and yet when you look very closely, he has about almost $500 billion US in assets around the world. It gives you an idea of the size and scope of his operations in all sorts of industries. And yet, when you drill into it a little bit closer, you see where are his investments. His investments are in Canada, they're in Australia, they're in the UK, and maybe a couple of other European countries. And that's about it. He's very geopolitically conservative. Now, when it came time to invest in the mining business, he said, now, Warren, we have to invest like I invest, which is geopolitically conservative. But I realize that you're in the mining business. And the mining business, you have to go where the mines are. So you're going to invest in places that I wouldn't necessarily go. Maybe Argentina being an example of that. Maybe Bosnia being an example of that. So that's okay. I understand that. You need to go where the ore bodies are. Just don't go to any funny countries. And what he meant by funny countries are, places where at the end of the day you probably don't own anything. Places like the Philippines, places like Indonesia, places like mainland China. And we can find the odd example throughout the Americas. Most recently, for example, Panama.
Mm.
So, echoing Mr. Lee's words, we do have to go where the ore bodies are. We are in the mining business, so that does involve more geopolitical risk than like a manufacturing business. But we do try to keep it reasonably safe. I mean, Bosnia, as an example, not a well-known mining country, but it's part of the EU. It's part of Europe. So we are still invested in Europe. And my goodness, what Paul Cronin and his management team did at Adriatic in getting that ore body permitted within less than a year of me extending him our convertible debenture. I thought it was going to take him 3 or 4 years. He did it in less than a year. So far, Bosnia has proved to be an excellent country in which to operate. Chile, uh, if you're going to be in the copper business in a big way, you have to be in Chile. And the future price of copper is going to be driven by Chile. Uh, I'm reasonably comfortable, again, long term with Chile. Argentina has got a huge mining future. Yes, they've got their own political and macroeconomic issues, but I think despite that, the mining business will continue to flourish. And we've seen some of the most exciting mining plays in the world this day. Uh, going down in the Vicuna area with Lundin and Filo and Jose Maria and so on, so dominated by Argentina, and I think that's all going to work out very well. So you're right. We have to take on some risk by nature of the industry we're in. We do try to mitigate it.
Interesting you should mention the Vicuña district. Queens Road Capital is not in Filo or NGEX or any of the other plays in and around there. Is that because of valuations, because they ran away basically from you, or is there another reason?
It's not as if I haven't tried, because I would love to have exposure to any of those names. They're very well supported by the Lundin family, which is a billionaire family. So anytime I've tried to do a convert with a Lundin family, the family has simply stepped in and said, "Well, that'd be a great deal. We'll do it." And so in terms of providers of capital, the Lundin family is a great supporter of their own companies. If any of them listen to this interview, I'd be glad to lend a hand, and I've told them that previously, but it hasn't happened yet. I wouldn't say I'd give up, but yeah, the family has great depth of balance sheet on their own.
That's one way to put it. They're wonderful stewards of capital, maybe not as wonderful of competitors when it comes down to financing. What are some other unfunny countries that you don't have exposure to, but would like to have exposure to? Because I'm not hearing anything about Northern Europe, for example, when there seems to be an emergence of Finland, for example, with gold and stuff like that.
Absolutely. It's simply because we've only got 7 investments. When we have 15 investments, I'm sure one will be in Finland or Sweden. Scandinavian countries get great place to do business. There are parts of Canada I'd like to have more exposure to. I mentioned Quebec, I mentioned New Brunswick, the Yukon territory, I think, and we've seen a lot of great discoveries there in the last couple of years. Very mining friendly and a great place to do business. So both in Canada, in the US, throughout Europe and South America, there's still plenty of great ore bodies in good locations.
Well, when you mentioned the Yukon, who are we talking about, Brandon or Scott?
There's all sorts of opportunities there, and in as you say, in the zinc business, in the gold business, great ore bodies in great jurisdictions. So I like them all.
Okay, good. I like the positive attitude there. And I like the talk about the ore body because it's a very bottom up approach as opposed to a top down. Because again, you also say commodity agnostic, something we can also talk about. I burned my hands once being commodity focused, and now I'm trying to do that same thing, go bottom up as opposed to top down. But haven't you recently moved a little bit away, or at least diverged from that model with your recent investment? Because now you're putting money into a royalty company and not necessarily into an ore body.
Yeah. Let's talk about that a little bit.
Sure.
Our most recent investment into the New York listed Gold Royalty Corp. Gold Royalty's biggest investments are in 3 great ore bodies. We're looking at Malartic in Quebec, which is Canada's largest gold mine. Yep. We're looking at Côté in Ontario, which will become one of Canada's largest gold mines. And we're looking at Ren in Nevada, which is effectively the extension of Goldstrike with Barrick Newmont. So they have exposure, and not just financial exposure, but geologic exposure as the ore bodies expand to three great ore bodies. So they're doing what we're doing, but they're a little bit more diversified. So very consistent in that regard in terms of exposure to great ore bodies. The other things that really attracted me to Gold Royalty is all of the companies that we're invested in, and Gold Royalty was our seventh investment. None of them have any cash flow. Obviously, they're pre-operation, they're even pre-development. None of them have any cash coming in. Gold Royalty is a gold royalty company that has income. It has revenue. It's the only company that we've invested in that actually has cash flow. So in terms of mitigation of risk, they've got cash flow, whereas all the others don't. So one might argue that it's the least risky investment. But we're getting a 10% coupon at Gold Royalty. It's the highest coupon that we get in our entire portfolio currently. So one might argue it's the riskiest investment, and yet they're paying us the highest coupon. All really attractive reasons, and I think it explains why we did that investment.
Mm. Well, it checks the boxes, basically, I suppose, of the first three things, because you're a preferred debt owner with the convertible note. You have a dividend, so you're not losing their money, the people's money. You're getting a dividend, and there's that upside with those three ore bodies. But so it's basically, I mean, you're not necessarily changing your strategy. This is just another way to play your strategy.
Absolutely right. And it's not the first time I've done this. With CEF, we did a very similar sort of thing with a company called Mavericks Minerals. And you might recall Mavericks was basically a spin out of Pan American Silver, led by a longtime supporter, geologist, very smart guy by the name of Jeff Burns. And he started Mavericks. And we were an early supporter of him through CEF with Mr. Lee. And we made very, very good returns supporting Mavericks, which was a new royalty company. And eventually, after about 6 or 7 years, Mavericks decided to merge with, I think it was Sandstorm. Triple Flag last year. And all the shareholders did extraordinarily well. And so we've done it before with a startup royalty company called Mavericks under CEF, and Gold Royalty just looked like an opportunity to do it all over again.
Royalty companies have been coming up in recent years, and also they're really plentiful now, though. Like the competition in the royalty space is no longer the same as it was, like, say, 5 or 6 years ago. So I suppose that makes you even more picky on those companies than before.
Yeah. And as a result of the fact that there are so many of them, there'll be a lot of consolidation in the sector. You're seeing that every year companies are disappearing. And Gold Royalty itself has been a consolidator. In its first 2 years of operation, I think it acquired 3 or 4 other royalty companies. So it is itself part of this consolidation wave. And as that industry consolidation continues, we take out G&A costs, we get critical mass, we get scale, we get lower cost of capital, and the shareholders do quite well.
I believe I watched an interview of yours once where someone asked you, why not just become a royalty company yourself? I mean, you definitely have the means for it. And you said that unlike, let's say, a precious metals or a battery metals royalty company or whatever, you're not you're not constrained to one commodity. So you call yourself commodity agnostic. And I'm wondering how true that really is, because what if there's 3 more arrows that get discovered over the next 2 years? Will you expose the portfolio to like 99% uranium, or do you still pay some attention to the commodity?
I pay some attention to the commodity. Uh, I always want to have, when I say commodity agnostic, I always want to have the opportunity to buy things that are out of favor. I don't want to be, I mean, you mentioned, getting sort of pigeonholed and having to do one commodity.
Mm.
When you have shareholders' money to invest and you're forced to invest it in one commodity, that means that even though your gut is telling you, you know what, this commodity's had a good run, things are pretty darn expensive, you're still forced to invest in that sector. And I don't want to be forced to invest in a sector that I think is expensive. I want to find the things that are out of favor and try to catch things on the downswing. So I want to be in a position where we sell things that are in favor, monetize those investments, and buy things that are out of favor. And that's precisely what we did with our uranium investments. We're very strongly dominated now by uranium by virtue of success, because those investments that we've made in uranium have gone up 5, 6, 10-fold. And so as a result, our portfolio now in total is about 80% uranium. But that wasn't on purpose. It's been a result of success, and we won't complain and we won't argue with success. It's a wonderful thing. But I do like to have the diversification into other commodities, and I do like to buy things that are out of favor. And gold equities for the last couple of years have been out of favor. I think it'd be hard to argue otherwise. And that's why the last 2 or 3 investments we've made have been in the gold sector, because we think it's out of favor. Not so much the commodity. The commodity is doing quite well. Over $2,000 an ounce is nothing to sneeze at. But the equities are out of favor. When you look at the GDX and the GDXJ, the indices that follow the gold equities, both of them underperformed the gold price last year. Gold was up 13%, and neither the GDX or the GDXJ was up 13% last year. So it shows that gold equities are supposed to outperform the commodity, and they underperformed again last year, despite an up year for the price of gold. So it certainly demonstrates that gold equities are out of favor. So I feel quite good about investing in that sector when people are overlooking it.
But with nearly 3/4 of your portfolio now in uranium, with uranium being so much in favor right now, does that make the hair on the back of your neck stand up? And is it making you think about potentially starting to exit some of those positions?
Again, a great question, Antonio. I can see why you would ask that question, but in this case, no. We're in the early days of this uranium bull market, and we're certainly in the early days of the value of NexGen and ISO. I mean, those 2 ore bodies are spectacular, and when they come into production, the level of cash flow that they will generate is astounding at this uranium price, frankly, at a uranium price that's half this level. And if those companies are valued even at half the multiple that Cameco has historically been valued at, we're looking at 10 baggers from here. So no, I'm not. I will take more of both of those companies if the opportunity arises, notwithstanding the great bull run we've had in their equities and in the commodity, in the uranium price to date. It's still early days in that bull market. So far from looking to exit, we're looking to add.
Well, people on Twitter are going to enjoy hearing that. I can tell you
well,
that.
they should, and I've been saying it for years, and I've been right, and I'll say it again. It's the early stages.
Right. Well, I think that no one doubts that Hurricane and Arrow will go into production eventually. But do you think it's NexGen and respectively Fission, NexGen and those two always go together. But NexGen and ISO are the ones who are going to bring that into production, or do you think it's going to take a BHP or a Rio to step in and do that for them?
They're very small mines, Antonio, so both of them can be developed by independent companies. They're certainly not a financial constraint. I mean, you're talking a capex of Arrow of, somewhere, but, or maybe call it $1.5 billion. Well, I think NexGen today is sitting there with 500 million in cash on its balance sheet, and they've had multiple offers of $1 billion in debt. So they can easily finance it today without raising another dollar of equity. And the price tag for ISO would be less than that. So financially, there's no question that we can do it independently. Will we get to that point? That's a question of, for the M&A departments in Rio and BHP and, certainly these are some of the greatest ore bodies on the planet in any commodity. The majors would love to have them. At some point, they might decide that they will have them. We'll see.
What would you prefer? Like, just personal opinion as a board member of NexGen, would you prefer the company develops it on their own, or would you like to be bought out at a premium?
No question. In terms of long-term value for shareholders, I think there's no question the maximum long-term value is we do it ourselves. The cash flow that Arrow will generate and the multiple that cash flow has historically received, when you look at the peer group of Cameco, the upside, the numbers are very easy to calculate. So in terms of the potential longer term upside in the equity, it'd be very hard for someone to pay the net present value of that today. So, I hope we get the opportunity to build this thing.
Where I'm coming from with this is because you mentioned the amount of money that NexGen has in cash, which is astonishing. But I'm also thinking about the money they are spending. So, for example, you with Queens Road Capital, you spend about 150 to some months, 200 grand a month over your last reported quarter. That was, if we annualize that. NexGen spends close to $5 million a month over that same period. And I mean, there seems to be a divergence in strategies of running a business here between you and Lee. And it just interests me, like, how do you look at how do you look at that? And maybe when you talk about looking into a company, if you're looking into a company, do you ever look at their financials and look at the amount of money that they spend? So I suppose it's a twofold question here. What do you make of NexGen's, relatively high spend, and how do you typically deal with the financials of companies you invest in?
Yeah, no, again, Antonio, lovely, great questions. Yeah, Lee runs a very different business than I do. Lee is going to be building a mine. So he needs to staff up to build a mine. He needs to hire hundreds of people. He needs to lobby provincial governments, federal governments, regulatory agencies. He needs to do a lot of local community work to make sure that we have a social license to operate in the community. He has a lot to do, a lot of balls to juggle. As you mentioned early on, Queens Road just sits there. I've got 3 employees, including myself, and I don't need to hire anyone. I run a lean, mean shop, and I leave the hard yards to guys like Lee, who have to go out there and get permits and build mines. Frankly, I've got the easy job. He's got a very, very tough job. So they're fundamentally different businesses with fundamentally different requirements for cash and cash going out the door. So I recognize that, and I'm more than happy with it. But you're right. I do look at, when I'm making an investment decision, I look at the capital intensity required to bring a project into production, because in large part, that's the role I play. I'm the guy who's saying, I will fund you between discovery and construction. And so obviously it's in my interest and in our shareholders' interest that that cash requirement during that period is as reasonable. I won't say as minimal, because you don't want it to be too minimal, because you want to do a proper job, but is as reasonable as possible. And you try to make sure that you're investing in an ore body where that's possible and a management team that will do it prudently. That's part of the job. Quite right.
What do you then make of marketing spends? Not necessarily with NexGen, but also with NexGen. They get a lot of flack for that online, and I feel like maybe a lot of people don't see it from the side that you, as a director, or Lee, as a CEO of the business, sees it. And so, with that, generally, what do you make of marketing in a space and the way our space has begun to market itself? How do you look at marketing?
Yeah, and I think that's an area that Lee, and when we say Lee, I guess we should tell your viewers we're talking about Lee Courier, the CEO of NexGen, and I think that that's something that Lee has been extraordinarily good at. He recognized that the mining industry hasn't historically been good at marketing itself to the global public and marketing itself to local communities to earn their trust and to earn that social license. And he said from the very beginning, we're going to do this differently. We're going to take an active part in getting our message out and making sure that whether it's on the world stage or on the stage of the Athabasca region of Saskatchewan, people know our company and know our values. And at the end of the day, that'll pay off in spades for the shareholders of NexGen. And I think it's the right call. Not all companies can afford to do it that way, because not all ore bodies are as cash generative as Arrow is. But the size of the prize is so big at Arrow, that marketing push is very important and great value add, in my view.
I once asked one of their, well, I cannot call it larger, but a large to my taste shareholder, what do you make of the spend? For example, a couple of $1 million on putting the logo on an F1 car, and he said, let me ask you that in return. What do you make of the potential of a Saudi sheikh putting, $50 million into this? Is that marketing investment not paid back on top of the lobbying power that it has? So that's sort of how someone explained it to me, and I have a feeling you have among the same thoughts.
Exactly right. I mean, leave no stone unturned on a global basis in terms of looking for partners, looking for investors. Don't think of yourself as a small underground mine in the northern the Athabasca region of Saskatchewan. This is a industry shaping ore body, and it will garner the attention of global players. But you have to go out and get their attention. You have to do things that will get the attention of Middle Eastern sovereign wealth funds. And historically, the Canadian mining industry has not been good at that. So I think this is a tremendous effort.
What is a red flag in a company, albeit financials or something else, that like someone pitches you a story and the moment you hear that one thing, you just drop it or you don't think about it? What's a big red flag?
A big part of it is track record. As I said, I know the CEOs of most, if not all, well-established mining companies around the world, and through the track record of that individual, whether they can pull this thing off. And That is really, really important. Know the person that's on the other side of the table.
Mm.
So the track record of the individual is a big red flag. Uh, it can be a big red flag saying full steam ahead. It can be a big red flag saying, I don't care about the ore body, don't touch this. So reputation goes a long way.
Mm. That's yeah, I mean that, and again it goes back to your three principles there that we've been talking about since the beginning. And you've also like you've influenced quite a lot of generalist investors and specifically billionaire generalist investors who were not in mining to get into mining through your company eh, by using those three type of things, don't lose their money, give them unlimited upside and pay them a dividend. Do you think it will, or let me ask you that way. What do you think it will take to convince more generalist investors from, let's say, North America to start coming back into the markets, like the Canadian pension funds, for example, all-time low exposure to their own industry in their own country. So what do you think it's going to take to convince them to come back?
Wow, tremendous. You're right. I have been very fortunate in that I've had uh, good success in getting guys who don't know a great deal about the resource business to invest with us. And whether that started off with Mr. Lee at CEF. Mr. Lee had never invested in a mine in his life. And I got him to invest in the sector. Uh, and then when we started Queens Road, Jack Cowan, my largest shareholder, he's the fast food king of Australia. He had not been a resource investor. The second largest shareholder is the only guy that really had any mining experience, which was, Andrew Forrest. And Andrew, as everyone knows, has made his fortune in the iron ore business. He came along. But the next two fellows, Brett Blundy and John Singleton, two self-made billionaires in Australia, they were not resource investors. So you're right. Our model does attract guys who say, yeah, I want exposure to this industry, but I'm not a mining guy. I'm not a resources guy. I'll let Warren pick that and I'll let Warren structure it. And we get the upside and we get the downside protection. So it's a model that works for that group. Your comments about the Canadian pension industry really, really irk me. You're absolutely right. I don't think Canada Pension Plan has a single mining investment. Teachers has made a couple at the margin. The others, I don't know if they've made any. Mining is a no-go area for Canadian pension money. That's embarrassing. It's not as if there isn't good money to be made in the mining industry. Fortunes have been made. You look at some of the richest people in Canada historically have been and are people who made their fortune in the mining business. What's wrong with the Canadian pension industry? I think part of the problem is that they've had their fingers burned in the past when they have tried to invest in the industry because they've done such a bad job of investing in the industry. And so as a result, they've said, we're so bad at this, we better not touch it. Well, that's the wrong answer. The wrong answer is invest in it more wisely. And they should be doing a better job. And frankly, as you might tell from my tone of voice, it really bothers me that Canadian pensions aren't supporting their own industry.
Mm-hmm. But is it their fault or is it our fault as an industry that we've let them down and that we've maybe become a playground for what is called the Vancouver Mafia? And can we really interest them back into the space?
We can interest them back in the space. You're right. It's not so much Vancouver Mafia as the industry generally in the last 20 years has not been a good steward of capital. And we all know that back from the 2007 to 2008 heyday and a lot of money that was wasted. The industry has done a poor job of managing capital, and the pension plans have made a poor job of investing in the industry. Both need to do better. And I would argue that Queen's Road is an example of how to do things right in the industry, so it can be done. You know, blaming it all on the industry, I think, is a poor excuse. One can make money in this industry, make great money for Canadian pensioners, and it's their obligation, it's their duty to do so. If they need some help, they can call me.
There's a lot of people going to be calling you after this interview, hopefully. Uh, well, so yes, I agree. Queens Road does solve a lot of these things, but at the same time, Queens Road has tens of millions of dollars of capital to go into those convertible debt notes and have that strategy that's low risk, high potential upside. Do you think that retail investors can still make money in this market if they're not convertible debt owners? Like, is it still worth your time as a retail investor?
Yes, indeed. The easy answer to that comment, Antonio, is they can go out and buy a Queens Road Capital share for 75 cents. It's not as if our shares are $75, they're 75 cents. So it's easy for them to do what the billionaires do. Buy a share of Queens Road Capital and let me make the mining decisions for them. And oh, by the way, they get an increasing dividend every year too. So that's the easy solution for retail investors. But beyond that, if you're going to invest in mining equities, use some of these same principles. The fact that you're a retail investor and want to invest in a higher risk, earlier stage company because you're looking for the big score, try to mitigate that risk. Pick the high grade ore bodies, not the marginal deposits. Pick the ore bodies that are in safe places, not the ones that are in real high risk jurisdictions. Follow some of these same principles and apply it to your personal retail investing. And you will reduce your risk, which is the most important thing in the mining business. Do everything you can to reduce your risk.
So you would basically, if you were, if your life had gone in a different path and you were a retail investor today, you'd still just employ the same principles, only the equity of choice would be different. I mean, it would just be common shares instead of debt.
Yes, if you don't have the alternative of investing in a convertible, which I think is the preferred way to go, and therefore you should be buying Queens Road shares. But if for some reason you decide not to do that, you can still use some of the same principles when you're equity investing.
Right. Okay. It's I've recently learned about a strategy from a good friend of mine by the name of Lobo Tigre, who's defined the pre-production sweet spot is what he calls it. He basically says you buy on financing decision when the deposit has already been gone through the feasibility studies and it's got an FID that says this thing is going to be a mine, and then you sell on first pour. And so he ran the data back. He did a back test, and it showed that he almost always makes money, and the average return was something like 100% or something among those lines. Have you ever heard about the pre-prediction sweet spot? Is that a place you're interested in?
It's in a loosely defined way, Antonio. It's sort of like what we do. Only we try to get in a lot earlier, because if you wait for the FID, that actual decision to actually invest and build the mine, a lot of the upside is already built in. So you are giving up a lot of upside waiting for that decision, that FID. So we follow what Lobo Tigre is saying, only we try to get in a lot earlier. But generally speaking, there's a lot of value created once a mine is actually built and producing. Risk is reduced, and you've gone from a cash absorbing company to a cash generating company. So value will theoretically be created. And so I can see how we would get there.
Okay. That's a definitely a fair answer. I can see that it's getting dark in Hong Kong, so I don't want to keep you up all night. I really appreciate you putting all this time in me. Well, what do you think the next investment? What do you think the next step is going to be for Queens Road? Where's your money going?
We're just going to be doing more of the same, Antonio.
Hmm.
Uh, and, in all likelihood, it'll be some out of favor commodity. We've probably, as I say, I think the last three have been gold. So the next one probably won't be. And we've probably got enough uranium. So it'll be something else, but it'll be a convert into some lovely little ore body in a reasonably safe jurisdiction that allows us to increase our dividend next year.
You've been recently active, so excuse me. I don't assume you're looking to get active anytime soon because I can see that like your deals are relatively spread apart. Are you expecting anything over the short run?
Not in the short run. I think what we're concentrating on now is getting value reflected in our share price, getting the share price higher, raising some additional investment capital. In the last 3 months, we've spent 100 million US dollars on two investments, and we've paid close to a $10 million dividend to our shareholders.
Mm.
So in the last 3 months, we've spent about 110 million US. At some point, we're going to recharge the balance sheet a little bit so we can do some more, but not until the share price is significantly higher.